Well, good evening, ladies and gentlemen, and welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now, tonight we're going to look at defensive and conservative investing. This is a really important area to discuss because many people feel like investing is risky, and in many ways it is. But there are certain things you can do to make your investing portfolio safer. And we're going to talk about what those things are and why. So stay tuned for the video because I feel if you're interested in investing, then these are things you should really at least know about, if not incorporate into your own personal investing style. So let's get right into it. Now, first I want to examine why it's important to sometimes, if not always, invest defensively. Now, the main reason is to protect against a market crash or an economic recession. Those two often go hand in hand. Now, an economic recession, you probably know what this is, but I'll just go through it quickly. An economic recession is when the economy starts contracting. So this actually doesn't happen most of the time. Statistically, this can happen 1 every 5 to 10 years. But it's that time of the economic cycle that generates the most attention. Because when there's an economic recession, you get really bad things start happening really quickly. Unemployment usually goes up. People start getting fired, losing their jobs because businesses are really struggling with their cash flow. There's an old saying that good economic times climb the stairs and bad economic times take the window. So when the economy is going well, you'll normally see a very gradual increase in things like employment, in things like GDP or economic growth. And when there's a recession, things start going down very, very quickly. In the 2008 financial crisis and subsequent GFC, it was only a matter of months when the economies tanked, the stock market went through the floor, and people started to feel pain very, very quickly over a very short window of time. So that's something to keep in mind. So what happens in an economic recession is economic activity slows very, very quickly. And that means that businesses immediately stop selling as many of their products because people aren't buying them. Because people get scared, they may lose their job. And even if they don't, you can bet that they'll start saving more money and spending less money. Now that is bad for the economy, and it sort of creates a self-fulfilling prophecy. If people think there's going to be bad times and they stop spending, it usually contributes to the start of the bad times. Now, why is this important when it comes to investing? Now, the stock market is made up of publicly traded companies. Now, when an economic recession comes, people know that it's going to affect companies, businesses. So they're very quick to pull their money out of any stock that they may own. A lot of people will do this. And this creates what's called market panic. You get mass selling of companies, of stocks, because everyone's afraid that the companies they own are going to be impacted by the recession. And it's a fair enough opinion to have. So in a way, this is what turns people off investing altogether. They say you never know when we're going to have the next market crash, which is true. And by the time people want to sell their things, it's often too late. Now, in the last global recession, the GFC in 2008, there was a lot of people who lost a lot of money investing, who had money tied up in assets that lost a lot of their value. So today we're going to talk about a few things you can maybe invest in that will be safer investments in a time of economic turmoil. Now, the first thing I want to talk about is your attitude. So as I said before, normally the first thing when people do when there's any sign of stock market nervousness is they'll just sell. But even worse, some people will notice that they'll wake up in the morning and they'll notice that their stocks have gone down a whole lot, and they'll go, oh, it's just the market, it's going to go back up. And then maybe in a week's time it's gone down even more. And then it's lost another 10%, and then the next week it's lost another 10% again, and then the next week it might lose 15%. And that's when people panic and they say, I don't want to lose anymore, I'm going to sell out now. And that is definitely the worst thing you can do, because you lock in that loss, and what you've actually done is buy high and sell low, which is of course the opposite of what everyone knows what good investing is about. So that's the first thing to keep in mind. If you're sure about a company you own, there is no need to sell it in a market crash unless there's a specific threat to that particular business. Now, we're going to talk about this a bit more later as well, but there are certain businesses that are more susceptible to economic crashes, and there are some that are more or less almost immune. Okay, so let's get right into it. So the first way you can invest defensively is investing in dividend-paying stocks. Now, for those of you who don't know what a dividend is basically a sum of money that the company that you might own shares in pays you every 6 months to hold that stock. Now, it's based on a percentage of how much money you have in the company. So most companies will pay between a 3 and a 6% dividend. So if you have $100 invested in that company, they'll pay you $6 a year, or $3 every 6 months. Now, companies that pay dividends will usually pay them no matter what the stock market is doing. So if the stock market crashes, the company will still pay the dividend. So in a way, it's a safer investment, because even though you might be on paper losing a portion of the value of your shares, you're still getting that dividend. You're still getting income from the shares, which is sort of a buffer zone against that falling stock price. So that's one thing you can do to defensively invest, is have at least some dividend paying shares in your portfolio. The second way you can defensively invest that I want to talk about tonight is owning gold or other precious metals. Now, this is a more controversial way of investing, because gold doesn't actually provide income. It's merely an asset. So unlike a house or dividend paying shares, you won't get any return on your investment periodically. You simply buy it at one price and sell it at another. And if you make a profit, that's good. But if you don't, there's no mitigating income in between that, like there is with a house. Okay, so why I've mentioned gold is that gold actually usually has an inverse relationship to the stock market. Humans have had a fascination with gold ever since we started walking the earth. So people own gold because it's never really going to lose its value, what people are willing to pay for it. And investors know this. So in times of turmoil, people will seek gold because they know it's a stable, consistent investment. And that means that in times of turmoil, the price of gold usually rises. This is also true of other precious metals such as silver, platinum, palladium. So gold can be an effective hedge against economic recessions and stock market volatility. And I'm going to do a more in-depth video about gold in the future because I actually find it quite fascinating. Okay, so the third way of defensively investing is consumer staple stocks. Now, what do I mean by this? So in a recession, when people are tightening their belts, when they're not spending as much money, there are certain things that they stop buying. Probably cars, refrigerators, televisions. But there are some things that people never stop buying. Groceries, toilet paper, alcohol, cigarettes. There's also utilities, electricity, water. Those kind of things don't stop being used in times of economic turmoil. Coca-Cola, toothpaste, the list goes on and on. Now, if you invest in companies that make any of those products, they are likely to be relatively unscathed by economic turmoil because people will still be buying them no matter what. In fact, some of the things I just mentioned actually rise in times of distress in the market, such as alcohol. If people are distressed about maybe losing their job, they might drink more. I mean, it's depressing, but it's true. So an alcohol company is almost recession-proof. Same with a stock like Woolworths. People aren't going to stop shopping for groceries when a recession hits. They might tighten their belt a little bit, but people have still got to eat. So I would feel far safer if my money was in a stock like Woolworths than a stock like Ford, because I know that in a recession people are going to stop buying cars, but they're not going to stop going to the supermarket. Often a lot of these consumer staples companies also pay dividends, so you get that double benefit as well. So that's really something to keep in mind when it comes to defensively investing. Okay, so the fourth way of defensively investing I want to talk about is something called bonds. Now, bonds you probably have heard of, but maybe not understand what they are. Bonds are essentially loans. When you buy a bond, you're essentially loaning your money to whoever's issuing the bond. Now, bonds are traditionally a very high safety, low risk investment because normally the people who issue bonds are reputable enough that they'll pay them back. So most companies will issue bonds. Woolworths will issue bonds. General Motors will issue bonds. The Australian government issues bonds. The American government issues bonds. These are basically loans that you are lending money to the government. Now, these are very, very safe investments because even in times of turmoil, most companies that issue bonds aren't going to go bankrupt, such as Woolworths or the Australian government. So in times of economic turmoil, bonds are providing a positive return on your investment, whereas a lot of stocks may not be. So bonds are a traditional favorite of balancing a portfolio to get that exposure to some defensive assets. Now, there are a few ETFs that actually just trade in bonds, so it's a really easy way of getting into bonds. If you want to have a portion of your investment portfolio in bonds, all you have to do is buy shares in the ETF that owns the bonds, and you'll have direct exposure to bonds. And they'll normally pay a yield that's slightly better than a bank savings account. Another thing to keep in mind is bond prices can actually rise during a recession because they have a relationship to the interest rate. And interest rates are normally cut during times of economic downturn. So your bonds will actually become more valuable in times of economic recession. So you can see that inverse relationship between stocks and bonds. Okay guys, so the last way of defensively investing I want to talk about is a little controversial, and I actually probably wouldn't recommend this, but it's buying what's called shorts. So shorts are actually a way of benefiting when a stock price goes down rather than when it goes up. If the stock price goes up and you're shorting it, you'll lose money, but if it goes down and you're shorting it, you'll gain money. And just like with bonds, there are ETFs available that will do short selling for you. So say if the share market drops 10% tomorrow, your ETF might go up by 5 or 10%. So it's another way of hedging against a stock market downturn. But it is a very, very risky, expensive, and complicated way of investing. I just thought I'd throw it in there because it's something that a lot of people do, particularly professional investors. And there are ETFs that make, if you really want to get into short selling, that you can buy into, and they will short stocks for you. But it is a really complicated and tricky way of defensively investing. And I just thought I'd throw it in there because it has a place. But again, it's not for the faint of heart, short selling. Okay guys, there you have it. I've talked about defensive ways you can invest. I hope that this has been educational for you guys, because investing seems really scary to a lot of people. And if you do any one of these things, you'll actually really put yourself in a really good position if there is a stock market crash. And I do a lot of these things, and I can tell you it doesn't really bother me when there's a crash. If there was a crash, I sleep soundly at night, knowing that I have dividend paying shares, exposure to precious metals, knowing that I have shares in consumer staple companies. Alright guys, so thanks so much for watching. If you like this video, hit the like button, hit the subscribe button. We're back soon with some more videos, but for now, good night.